April spring has been in the air in some parts of the country. Rains brought wildflower blooms to some areas. In the major money centers of the world, any banking crisis appears contained, at least for the time being. But there seems to be a dual focus on the part of investors. With the turn of a month, the end of the first quarter, it is time to look at how U.S. real and global economies are faring. Another focus is on the Q1 2023 earnings season. And for all of this, we turn to our chief equity strategist and economist, John Blank. I tried to get a little creative in that open, John. After weeks of worry about the banking sector, recent economic data has investors shifting their focus, at least with one eye, back to the macroeconomic picture. What does that picture look like for you right now?
Well, Terry, we just got the Q1 advanced reading for the United States economy. It was 1.1%. That included something much more important was real final sales to consumers was up almost 3%, depending on how you adjusted it. So that was the strongest final sales for consumption we've seen in 7 quarters. That was masked by a big pullback in inventory, which generally will be discounted by the Fed. So the real story here is there has been no progress by the Fed in lowering the consumer's spending trajectory, and that's the market's pricing, and that's why we saw the 10-year move up 5 basis points today.
And everyone, I think, wants to know in plain terms whether the Fed's barrage of rate increases is cooling the economy. So from what I'm hearing, the answer is yes, no?
The answer is no. The Fed is not cooling the economy. And part of that was because of them having to step in and provide liquidity in the March banking crisis. And the other part of that is the bond market not believing the Fed is credible in holding rates high for the next year or so. The bond market is calling that bluff and thinking the Fed's going to come down with inflation later this year.
So let's talk about the bond market a little bit more. If banking tensions continue to recede, there should be sentiment for long-term U.S. Treasury yields to rise and the U.S. dollar to regain safe haven ground. But data shows that views on the likely trajectory of rates have once again diverged, right? So what's up with that?
Yeah, we've just been speaking about this, and we need to reiterate this. The Federal Reserve System, probably in the next week, will go to its meeting and raise rates 25 basis points to a terminal rate of 5 to 5.25. It's what their dot plots have said, and we can hold their feet to the fire on this one. Likely to pause in June, although they may go up. The Fed Fund Futures has 70% chance of 25 basis points next week, and only 20% chance for another 25 basis points in June. So the Fed's coming to the end. But what's interesting about that, when the Fed is at 5 to 5.25, the 10-year is now at 3.5. So that tells you something, that the bond market thinks the Fed's going to come off 150 basis points of cuts in the next 4 years. So think about when that's going to happen. But that's the message here, is that everybody in this bond market is already way out in some deflationary scenario, and the Fed isn't. And that is just where we are until we aren't. And it typically is the case, the bond market won't reconcile with the Fed until some uncertain place in time. But there's entirely possible that you can see a 50 to 75 basis point rise to the prior 4.25 10-year high in a matter of 8 to 10 days.
You wrote in a recent commentary that conviction is now building among investors and central bankers that banking stress and a potential follow-on credit crunch make a hard landing for the world's largest economy more likely. How likely is that more likely that it happens this year?
Well, I think Goldman Sachs, which is, by the way, fairly bullish, has the right measure of this, which is 35% chance of recession in 2023. I think that's about right. There's about a 1/3 chance it happened this year. I think it's probably closer to 50-50 for 2024.
Now enter the Q1 2023 earnings season that investors are going to be focused on with their other eye. They currently are as we speak here on April the 27th. So far, it looks to be off to a solid start. How do you feel about it?
That's absolutely the case. I'm looking at a minus 6.2% blended earnings decline, which is really, to be expected. And the forward change in the earnings per share is, for the most part, gone, sideways for the last few weeks. Obviously had gone down before that, but it is stabilizing. So I think the main point to be taken from earnings is, we've got a decent amount of beats averaging around 7%. 80% of people who have reported are beating, which is relatively strong within the range of normals situations, and the stabilizing. So the point here is, from both the GDP report this morning at 1.1% and the stabilizing earnings scorecard, that in fact we are in a soft landing right now. It really remains to be seen how long the soft landing holds up, and I think that's where people in time need to be. We're in a soft landing, probably have been here for 2 or 3 quarters, and it's just a matter of how long it holds up.
Wall Street had been worried about an earnings recession amid expectations of a second straight quarter of corporate profit decline. So what's the likelihood of that?
It happened. We have an earnings recession, and people need to realize it's backward looking. The market looks forward, so it doesn't matter.
Would that earnings recession derail the current stock market rally going forward?
It will not, unless we get an outlook coming from enough companies in the S&P 500 that go down. And frankly, they've been holding up. So there's many people who reaffirm guidance that are major companies that people care about. And that's the stabilizing story we've been talking about.
Big tech has been rather strong lately. Is big tech going to continue to be a market leading sector for most of the rest of the year?
Absolutely. Wall Street gets a lot of credit for some things and gets some blame for other things. But what it does do is it circles around a champion and builds it up through M&A. And that's what's happened over the last 10 or 15 years. Amazon is multiple companies. Meta is multiple companies. And the same is true for Google. And across the board, you have to realize that if you want to be in the marquee, high market share areas of tech, you got to own the big tech names, and you do have to pay up a premium for them. And that's just basically the case. Today's rise of 15% in Meta just tells you that there really is a lot of steam in those shares if you pick them right.
Speaking of tech stocks, here are 3 large cap tech stocks with a Zacks B rating for growth: Infineon Technologies, AG, C Limited ADRs, and ST Microelectronics, NV.
Infineon, I've loved this name. I still do. IFNNY. It's trading at about $35 a share. We've got a $42 share price target. Number 1 rank with a B for growth, and this is Siemens spinoff of chips for autos. Now, what you need to realize is this is basically a German chip maker, and the European electrification drive across automotive vehicles is much more mature than the United States. Not as mature as China, but very strong. And stock continues to get earnings upgrades because of its position there in that growth. So you have to like Infineon. There's a prior high at $50 a share. It could certainly reach that. SC Limited, C Limited, Terry, you probably don't know this. C as in the ocean, the sea. Ticker SC. This is a Zacks number 1 rank with a B for growth. Why you don't know it is it's in Singapore, and it's basically 20% owned by Tencent, the big Chinese company. It's kind of a mini Tencent / JD / Alibaba that's for ASEAN, which is Thailand, Vietnam, Malaysia, Indonesia, Philippines. So this stock is at $75 a share. The thing that happened here is they were just growing like crazy but not making any money. Then they turned to a Zuckerberg play and started getting focus on profits, and their earnings estimates have ratcheted up. So if you're looking for a big tech name to drive emerging market growth, you need to look into ticker SE, C Limited. ST Micro is the last name. These guys just reported, and the stock's down 8% today. $42 a share. Nice entry point, by the way, because it is a 2-rank stock with an A for growth. If you're looking for a long-term play, this is one to consider. You've got a forward P of 11 now. They're in a much broader range of chip markets than Infineon. And there is stabilization in their earnings, not so much growth. So really, this is when you have to buy a name on a pullback. You might want to wait a few days to see when the ST Micro pullback plays out after its earnings, but it's kind of an interesting name to take a look at right now.
Our chief equity strategist and economist, John Blank, taking a look at the big economic and earnings picture. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.